Hey, folks, it's your boy, the boss of economics, back to dissect the latest economic circus show. Today, we're diving headfirst into South Africa's economic quagmire, where the South African Reserve Bank, SARB, is juggling flaming torches in a room full of dynamite. They're set to slash interest rates on Thursday, May 29, 2025, because apparently, the solution to a faltering economy is to double down on the same policies that got us here. Buckle up, because we're about to expose the government's mismanagement, the central bank's desperation, and how global trade wars are just the cherry on top of this economic dumpster fire. Let's go. Here we go again, folks. The South African Reserve Bank, under the fearless leadership of Governor Lesetja Kganyago, is gearing up to slash its benchmark interest rate by 25 basis points to a measly 7.25%, a level we haven't seen in over 2 years. Bloomberg's economist polls are buzzing with excitement, with traders betting an 84% chance on this cut, as shown by forward rate agreements. Sounds like a party, right? Wrong. This isn't a celebration, it's a desperate SOS from a central bank trying to prop up an economy that's been kicked in the teeth by years of government mismanagement and now faces the fallout of Donald Trump's trade war tantrums. But here's the kicker, this decision is expected to be split. 4 out of 6 members of the Monetary Policy Committee, MPC, are predicted to back the cut, while 2 are holding their ground, probably because they can smell the disaster brewing. And let's not forget, back in March 2025, the SARB paused its easing cycle after cutting rates by a cumulative 75 basis points. Why the pause? Because the escalating uncertainty around US tariffs was like a dark cloud hanging over Pretoria. Now, with Trump graciously pausing his reciprocal tariff hikes until July 2025, the SARB sees a tiny window to act. But is this a golden opportunity, or are we just rearranging deck chairs on the Titanic? Let's start with the obvious, folks. South Africa's economy is in the gutter. The National Treasury just dropped a bombshell last week, May 19, 2025, slashing its economic growth forecast for the next 3 years to an average of 1.6%, down from an already pathetic 1.8%. For context, sub-Saharan Africa as a whole is projected to grow at 3.6% in 2025, according to the IMF's latest World Economic Outlook, April 2025. So, while our neighbors are sprinting, South Africa is crawling, weighed down by a toxic mix of domestic mismanagement and global trade turmoil. The SARB's argument for a rate cut is simple: borrowing costs need to come down to stimulate this zombie economy. Inflation is under control, hovering below 3% annually, well within the SARB's target range of 3–6%. And hey, Finance Minister Enoch Godongwana's latest budget is expected to pass, which has economists like Kibetswe Mojapelo from Rand Merchant Bank popping champagne, claiming fiscal risk has diminished meaningfully. Translation: the government might actually stick to its spending promises for once, so the SARB feels safe to cut rates. But hold the phone, folks. If everything's so rosy, why is the economy still faltering? Why are we stuck with growth forecasts that wouldn't even impress a snail? This is where the surface-level story starts to unravel, and we dig into the real dirt. Here's the part where we call out the elephant in the room, the South African government's chronic mismanagement. Let's talk numbers, because numbers don't lie, unlike some politicians. According to the World Bank's South Africa Economic Update, January 2025, the country's public debt to GDP ratio has ballooned to 75.3%, up from 56% just 5 years ago. Why? Because the government has been spending like a teenager with a stolen credit card, while state-owned enterprises like Eskom and Transnet bleed cash faster than a sinking ship loses water. Eskom, our beloved state power utility, is a prime example of government incompetence. In 2024 alone, South Africa endured over 300 days of load shedding, power cuts that crippled businesses, halted manufacturing, and sent small enterprises to the graveyard. The result? A manufacturing PMI, Purchasing Managers Index, that's been stuck below 50, indicating contraction, for 18 consecutive months, as reported by the Bureau for Economic Research, BR, in April 2025. And let's not forget Transnet, our state-owned logistics company, which has turned our ports into the world's slowest choke points, costing exporters billions in lost trade. So, when the SARB says it's cutting rates to support a faltering economy, what they really mean is they're trying to clean up the government's mess. But here's the problem, folks: lower interest rates don't fix structural rot. They might give consumers a bit more cash to spend and businesses cheaper loans, but if the lights keep going off and goods can't get to market, what's the point? This rate cut is like putting a band-aid on a broken leg. It might look good, but the patient still can't walk. Now, let's zoom out to the global stage, because South Africa isn't just a victim of its own government's incompetence, it's also caught in the crossfire of Donald Trump's trade war. For those of you who've been living under a rock, Trump's America First policy has unleashed a tsunami of tariffs, counter-tariffs, and economic uncertainty. South Africa, as a major exporter of minerals, automotive parts, and agricultural goods to the US, is right in the line of fire. Here's a jaw-dropping stat. According to the U.S. International Trade Commission, South Africa's exports to the U.S. dropped by 12% in 2024, largely due to Trump's tariffs on steel, aluminum, and other goods. And now, with Trump pausing his tariff hikes until July 2025, the SARB sees a window of opportunity to cut rates. But let's be real, folks, this isn't an opportunity, it's a stay of execution. If Trump escalates his trade war again, as many analysts predict, South Africa's export-dependent economy will take another hit. The World Trade Organization, WTO, warned in its World Trade Report 2025, released April 2025, that global trade volumes could shrink by 2.5% if tariff escalations continue, with emerging markets like South Africa bearing the brunt. And here's the kicker, the SARB knows this. That's why economists like Shannon Bold from the BER are warning against a rate cut, pointing to risks like oil and food price shocks that could spike inflation. Speaking of which, let's talk about those domestic risks, because they're a ticking time bomb. Alright, folks, let's talk about the real risks the SARB is conveniently downplaying. First up, inflation. Sure, it's below 3% now, but that's not the whole story. Food inflation is already rearing its ugly head, driven by increased demand for meat and a spike in vegetable prices due to heavy rainfall disrupting harvests. The BER estimates that food inflation could hit 5.5% by the end of 2025, up from 3.8% in early 2025. And don't forget the fuel levy increase set for June 4, 2025, which will push up transport costs and, you guessed it, inflation. Here's a stat to make your blood boil. According to Stats SA, the poorest 20% of South Africans already spend 40% of their income on food and transport. So, when inflation spikes, who gets hit the hardest? Not the politicians in their ivory towers, but the ordinary people struggling to put food on the table. And what does the SARB do? It considers cutting rates, which could weaken the rand and make imported goods, like oil and machinery, even more expensive, fueling inflation further. Genius, right? But wait, there's more. Let's talk about the rand, which has already depreciated by 8% against the US dollar in 2024, according to Bloomberg data. A weaker rand means higher import costs, which means higher prices for everything from fuel to consumer goods. And if the SARB cuts rates, it risks further capital outflows as investors flee to higher-yielding markets, putting even more pressure on the rand. It's a vicious cycle, folks, and the SARB is playing Russian roulette with the economy. Now, let's step back and look at the big picture, because this rate cut isn't just about South Africa, it's a symptom of a failing global economic model. Central banks around the world, from the Federal Reserve to the European Central Bank, have been slashing rates and printing money for years, trying to prop up economies battered by government mismanagement, trade wars, and structural weaknesses. But here's the truth, folks, monetary policy can't fix what's fundamentally broken. South Africa's economy is a textbook example of what happens when you combine corrupt governance, crumbling infrastructure, and an over-reliance on volatile global markets. According to Transparency International's Corruption Perceptions Index 2024, South Africa ranks 83rd out of 180 countries, a shameful slide from its position a decade ago. Meanwhile, the World Economic Forum's Global Competitiveness Report 2024 ranks South Africa 60th out of 141 countries for infrastructure, behind countries like Rwanda and Kenya. And let's not forget our unemployment rate, which hit 33.5% in Q1 2025, according to Stats SA, the highest in the world. So, when the SARB cuts rates, it's not solving these problems, it's just kicking the can down the road. And when the can finally explodes, who's going to pay the price? Not the politicians, not the central bankers, but you, the ordinary South African, stuck with higher prices, fewer jobs, and a government that couldn't care less. Alright, folks, let's wrap this up with some real talk. This rate cut is a desperate gamble by a central bank that's out of ideas, trying to prop up an economy that's been gutted by years of government mismanagement. And don't even get me started on Trump's trade war, which is just pouring fuel on the fire. The SARB might think it's being clever, but it's playing with matches in a room full of dynamite. Inflation is coming, the rand is tanking, and ordinary South Africans are the ones who'll pay the price. So, wake up, South Africa. Demand accountability from your leaders, because if we keep letting them drive this economy into the ground, there won't be anything left to save. This is Boss Economics World, signing off, stay woke, stay broke, and I'll see you in the next economic train wreck.